You make your mortgage payment, mow the lawn, and think, finally, it's mine. But the truth? The bank owns 90% of your house and collects triple what you borrowed through interest. In 30 years, a $400,000 loan can cost $863,000. So why do we call it ownership when it's really long-term rent with better marketing? The illusion of ownership. A young couple stands in front of their new house, keys in hand, saying, "We finally own it." Yet if you check the math, the bank owns almost all of it, about 90% for the first decade. That's the strange truth about mortgages. They make you feel rich while quietly keeping you in debt. A mortgage is a loan backed by the very home you think you own. If you miss payments, the bank takes it back, because legally the property is still theirs until the loan is cleared. That's why banks love 30-year mortgages. They get decades of guaranteed interest, while you carry decades of risk. Take a $400,000 mortgage at 6% interest. Over 30 years, you'll pay nearly $463,000 in interest alone, more than the price of the home itself. In the first 5 years, around 70% of your monthly payment doesn't even touch the loan balance. It all goes to interest. You're working for the bank, not for your own equity. This design wasn't accidental. During the Great Depression, shorter-term home loans led to mass defaults. To fix it, the U.S. government and banks introduced longer loans with smaller monthly payments, making housing seem affordable while extending debt for life. By the 1950s, the 30-year mortgage became the American standard, marketed as a path to freedom but engineered for long-term profit. IO's principle fits here. Value today always costs something tomorrow. Borrowing money is trading future labor for present comfort. You're not just buying a home, you're committing future years of work to pay for time itself. That's why most homeowners don't realize they've entered a decades-long partnership, one where the bank collects profits up front, and you build ownership slowly, brick by brick. And the story deepens once you learn how hidden mortgage traps quietly turn that illusion into a lifelong expense. The hidden traps that cost you thousands. Every homeowner learns this part the hard way. You think the worst is behind you after signing the mortgage, but then come the fine print traps that quietly drain your wallet month after month. Start with adjustable rate mortgages, or ARMs. They sound friendly, lower rates in the beginning, flexibility over time. But that flexibility often turns into a nightmare. Back in 2008, millions of Americans saw their interest rates jump by 3% or 4% almost overnight. A family paying $2,000 a month suddenly faced $2,700 or more. For many, that extra $700 pushed them straight into foreclosure. By 2009, over 3.9 million homes went into foreclosure. These weren't bad people. They were victims of fine print and false promises. Then there's PMI, private mortgage insurance. It sounds like protection for you, but it only protects the bank. If you can't put down 20%, you pay an extra $150 to $400 every month. Over 5 years, that's nearly $20,000 gone. And here's the trick. Once your home gains value, banks rarely remind you to cancel PMI. You have to beg them to stop charging you for it. Another hidden trap is the prepayment penalty. Some lenders charge you a fee if you pay off your loan too early. Yes, you heard that right. You get punished for being responsible. Banks design it this way because they want the long-term interest. It's like a friend who lends you money and complains if you pay them back too soon. Every one of these extras looks small, but together they can add decades of payments or tens of thousands in lost savings. IO warned about this kind of distortion. When incentives favor the lender, not the borrower, people lose their sense of economic reality. And that's exactly what happens next when you discover how banks keep profiting from your loan even after they've handed it off to someone else. How banks make money, even when you don't. Most people think banks lend you money and wait 30 years to get it back with interest. But that's not how it really works. The moment your loan is approved, banks package it, sell it, and move on. Your debt becomes their instant payday. Here's how it unfolds. Once your mortgage is signed, it's bundled with thousands of others into a financial product called a mortgage-backed security, or MBS. Investors, from pension funds to foreign governments, buy slices of that bundle because it pays steady income. The bank collects fees up front, transfers the risk, and starts the process again. In short, they profit before you've even made your first payment. By 2023, America's mortgage market had grown to $12.3 trillion, making it one of the biggest financial ecosystems in the world. That's more than the GDP of China. But here's the twist. Those trillions aren't built on houses. They're built on debt. You pay for decades so that someone else can trade your promise today. This system fueled the 2008 crash. Lenders approved risky loans, knowing they'd sell them off quickly. They didn't care if borrowers could actually pay. When homeowners defaulted, those mortgage-backed securities collapsed, wiping out $19 trillion in household wealth globally. And yet, the same structure still exists. Aya warned that when capital flows are distorted, prices stop telling the truth. Mortgage markets today look efficient, but are built on a fragile illusion of endless repayment. The more complex the system gets, the easier it is for everyday borrowers to lose track of who profits from their debt. And while the banks earn their share early, you build yours slowly. But that slow buildup, your equity, is where the story turns from trap to opportunity. The hidden power of equity. Every payment you make on your home feels like a bill, but it's more than that. It's a quiet transfer of power. Each dollar turns a little more of that house from the bank's property into yours. That's what equity really is, your share of something that lasts. At first, it grows painfully slow. On a $400,000 loan, most of your early payments go toward interest. But after a few years, the balance starts tilting. You pay less to the bank and more toward ownership. That's when the snowball begins to roll. Equity becomes a hidden savings plan, one that forces discipline in a way few people manage on their own. Over time, small percentages make huge differences. A home appreciating just 3% a year doubles in value in 24 years. That $400,000 house becomes roughly $970,000 in 3 decades. During that same period, you've been building principal with every payment. The mix of appreciation and repayment creates a compounding effect that outperforms most savings accounts. History proves it. After World War II, the GI Bill helped millions buy homes, creating one of the biggest wealth booms in American history. Families who paid off modest $10,000 homes in the 1950s later passed on properties worth hundreds of thousands. That's the quiet magic of ownership. Slow, invisible, but powerful. Ayao believed that capital in motion, money turning into productive assets, creates real prosperity. A home does exactly that when managed wisely. It's shelter, savings, and leverage in one package. But like any tool, it depends on how you use it. Because while equity builds freedom, time still shapes the cost, and the length of your mortgage can change everything about how that story ends. The game of time. 15 years versus 30 years. The difference between a 15-year and a 30-year mortgage sounds simple. Same house, same loan, just twice the time. But that extra time is what makes banks rich and borrowers tired. Take a $400,000 loan at 6%. Over 30 years, the total paid becomes about $863,000, more than double the price of the home. Cut that to 15 years, and the total drops to $608,000. That's a $255,000 difference. The shorter loan saves you a house within a house. But why do most people pick the 30-year one? Because the monthly payment looks smaller, even though it costs far more in the long run. In the 1950s, when America's housing boom began, most mortgages were 15 to 20 years. People finished paying them off before retirement. But in the 1980s, banks found something clever. Longer loans meant more interest, more profit, and easier approval for buyers. It made homes look affordable while quietly stretching debt across generations. Aya would say that time itself has a cost. And in this case, the longer you borrow it, the more expensive it becomes. The system rewards patience in investing, but punishes delay in repayment. That's the paradox most borrowers never see. Here's the twist. If you pay an extra $200 a month on a 30-year loan, you can shave nearly 8 years off. The small, consistent effort turns time back in your favor. The same principle that hurts you through compound interest can also help you if you flip the direction of the flow. However, all the math in the world means nothing if you don't know how to negotiate the terms in the first place. And that's where banks quietly set the stage for who wins and who pays more. Negotiating with the bankers. Most people walk into a bank thinking interest rates are set in stone. They aren't. The numbers you're offered depend on how the lender reads your risk, and that can shift with a single negotiation. Here's the truth. Banks make their biggest profits not from the interest rate itself, but from what surrounds it. Fees, points, insurance, and terms buried in the paperwork. Closing costs alone often range between 2% and 5% of the loan. On a $400,000 home, that's up to $20,000 in extra charges before you even get the keys. Most buyers accept them without question, thinking it's normal. It's not. A small cut in your rate, even 0.25%, saves over $20,000 across 30 years. Yet many never ask. Loan officers expect you to focus on the monthly payment, not the total cost. It's like selling a car by pointing to the shiny paint while hiding the engine stats. Credit scores are another quiet lever. Borrowers above 760 often get the best terms, but even moving from 700 to 740 can save thousands. Banks won't tell you that. They'd rather pocket the difference. The system rewards whoever understands its hidden math. Ayao always said economic success depends on understanding incentives. In lending, the bank's incentive is to maximize yield, while yours is to minimize cost. Whoever knows the rules wins. Negotiating rates, comparing offers, or prepaying principal early are small moves that shift power back to you. The mortgage game looks complicated because it's designed that way. But once you see where the profits flow, you realize it's not about luck, it's about awareness. The difference between being trapped in debt and mastering it often comes down to one simple thing: asking the right questions before you sign. Thanks for watching, and for being the kind of person who actually questions the system. Subscribe for more deep dives like this one, where we turn hidden numbers into real stories.